Welcome to the Allan Small Financial Show. Thank you for taking the time out of your busy day to spend it with us. We have a great show for you again today, a show packed with information, answering the questions that many have been asking me over the last, few weeks, really since the end of last year, pertaining to the market, individual investment ideas. We also have a tremendous guest, a great guest, someone that could speak to the growth of this province. Are we growing jobs? Are we bringing over businesses to our great province of Ontario? The Honorable Vic Fedeli will be speaking or spoke to me a few days ago. I had the pleasure of catching up with the minister, and we spoke about many things. He brought to us some really good information. And the Honorable Vic Fedeli is the Minister of Economic Development, Job Creation, and Trade. And just a great interview and really shedding some light as to what the province is focusing on and where business in the province is going. And here we have the topics for today's show. Again, attracting new business to Ontario, an interview with Ontario Minister Vic Fedeli. We'll be playing that right off the top. And again, if anybody has any questions regarding the interview, be happy to try and answer them, or perhaps take those questions to the minister himself. Top 3 things that I think individual investors should focus on before you make your investment decisions. We always have 3 topics, and we have those for you again today. Bank of Canada and the Federal Reserve, they've decided to hold rates for the time being, pushing off rate cuts. There was some talk we would see some rate cuts, perhaps as early as March of this year. Doesn't look like that's going to happen. The economies in the United States is quite strong. The economy in Canada is not as strong as U.S., but definitely not in recessionary times. And we're starting to see some pickup in some certain areas. Business and consumer bankruptcies jumping in 2023. Some alarming stats that I was able to find regarding insolvencies in 2023. Obviously, higher interest rates are contributing to those to that increase in insolvencies. Top 5 reasons why the bull market could hit a snag in 2024. I talk about all the time how I'm very positive on the markets in 2024. Most savvy investors, analysts, economists do believe we will see growth in 2024. But I thought it'd be interesting to talk about some of the things that perhaps, if they come true, not saying they will, but if they were to come true, why the economy and the markets could hit a bit of a snag in 2024. And lastly, your questions. Hopefully we can take a couple of your questions today. If you have any questions throughout the course of the show, during my interview with the minister or anything after that, please feel free to put them into the chat box. And we have people that are constantly monitoring those boxes for questions. Be happy to answer them on this show. And if I don't get to them on this show, I can either answer them during the next couple of weeks, or what I usually do is answer them on the following show. So without further ado, I'd like to get on with the show and my interview with the Honorable Minister Vic Fedeli. I'd like to welcome the Honorable Victor Fedeli, a lifelong entrepreneur, serving the Ontario government as Minister of Economic Development, Job Creation, and Trade. His business experience led his firm Fedeli Corporation to be ranked in the top 50 best places to work in Canada in 1989. It also served him well when elected to 2 terms as Mayor of North Bay. In 2011, Minister Fedeli was elected to the Ontario Legislature and is now serving his 4th term as MPP for Nipissing. He's married to local humor writer Patty and is often seen in one of his trademark yellow ties, which Mr. Fedeli, you're not wearing today, but as you said, you wear it quite often. So I think you're known for that now.
I wear a yellow tie every day, and here you go for this interview. I thought, I'm going to go on casual today. I'm going to show Allan the casual Vic today.
That's great. That's great. Well, thank you again for taking the time and speaking to us about our province and the growth in our province. I know many investors listening to our show, watching our show, would love to hear how our province is doing. You know, we're hearing a lot of mixed information, getting some mixed signals. So thought it'd be a great time to have you on the show. And I guess we'll start with a kind of a general question. You know, we often hear your announcements regarding investments in manufacturing, the auto sector, overall spend on expanding and growing the economy. We also hear about job creation programs. However, at the same time, we're also seeing that our economy is slowing really right across the country. And at the very least, there's people fearing that we could be moving into a mild recession. So, with all that in mind and all these mixed signals, how would you categorize the strength of the provincial economy at this time?
Well, thanks, Alan. I appreciate exactly the commentary that you made. And there are a lot of mixed signals out there, but let me be very clear about Ontario. We are, from a business perspective, I mean, both the Premier and I are lifelong entrepreneurs. We basically never work for anyone else other than ourselves and now the government and the people of Ontario. I would tell you that our economy is just on fire here. We are firing on all cylinders. Last year, I did maybe 15 countries around the world bringing in business. We've landed in the last 3 years $28 billion in brand new EV. We were never in the EV business before. About 3 billion in life sciences, tens of billions in tech. So in those countries that we visited and brought this business to us from, they said two things. All, for the most part, were, I would say, unprompted, Alan. They said, in this really tumultuous world, this looming recession, talk of recession, the COVID, we're over COVID, we're not really over COVID, not everybody's back, Russia's illegal war in Ukraine, this is before Israel now, we did not travel in November, December, the whole thought about China and supply chains, in all of that turmoil, they look across the ocean and they see this beacon of hope, this beacon of light, and that's Ontario. And one by one by one, they land here, like LG Energy with a $5 billion plant, Volkswagen with a $7 billion plant, and others. So I would say this targeted and strategic approach that we've taken to business, running the economic development in a business-like way, has just changed the narrative. We reduced the cost of doing business. We can talk about that more later. But there's basically 700,000 people more working today in Ontario than the day we got elected. So there's a couple of other really interesting stats. I'll just throw two more if you don't mind. Last year, we saw about 120,000 jobs created in Ontario, 1 year alone. This is an interesting stat that was ratified this morning by both the US Trade Department and Stats Canada. They both take a month to ratify their numbers. As of, for the entire year last year, all of 2023, Ontario created more manufacturing jobs than all 50 US states combined.
Wow.
That's the message people need to know. That's what we say. That's what we're talking about when we say Ontario is on fire.
That's unbelievable. I don't think I didn't know that stat, and I'm sure many others wouldn't know that stat either. But what would you say would be, I guess, the selling feature, right? What are businesses telling you as to why they're coming here? What would be the number one reason why they open up a plant or set up shop in Ontario?
So again, in those 15 countries where we heard from the governments and the businesses, they told us they saw this beacon of hope in Ontario because they see us as stable, reliable, dependable. They almost in a boring way that we're just they can rely on us. And secondly, they said we're safe. And so you take that as your reason to start looking at Ontario, and then they find out the jewel. It's our talent. It's all about our talent. We have 65,000 STEM grads every year. We have about 74% of our adult employees have a post-secondary education. We're one of the most educated workforces in the world. One of the messages I bring all the time to manufacturers is, think about Toyota in Ontario. Ontario's Toyota was named the best auto plant in the world. Not the best Toyota plant, the best auto plant. Think of how many thousands of auto plants there are. We have the number one auto plant here in Ontario. That tells you we know how to make things. Our people are what make our companies. That's
That's
really what
incredible.
it's all about. Yeah,
Yeah, it's the people for sure.
yeah,
You hear that a lot. Diversified, great workers.
yeah,
Manufacturing is what we
yeah,
do.
yeah.
Just maybe a more difficult question I would ask would be, what are some of the issues that companies are telling you? So for those that don't come here, that you go and meet and say, come on and open up in Ontario,
Yeah.
and they kind of tell you, well, reasons why they decide not to come here. And what are some of those reasons? And what would you say would be the number one thing if you could change, that you would change so that we could attract even more business to our province?
So we have a lot of really big advantages in cutting the red tape that we've done over the last 5 years. And so what I would say would be we need to do more. We need to continue to cut the red tape for these businesses. I think that's a really important piece where we need to continue making sure that we're educating our graduates in the fields that are going to be needed, making sure we're training our employees with the information that they need. And that's why I think about things like we have 85,000 AI workers in Ontario today. That's a remarkable statistic. So we need to continue working on the reduction of costs. When we first got elected, we heard loud and clear from business community, the Fords, GMs, Stellantises of the world, that our cost of doing business was getting to be too high in Ontario. And we immediately began to reduce the cost of business. I'll give you a couple of quick for instances. WSIB, workplace compensation. We had so much cash that we were drawing from businesses and stashing to make sure we had the money for the benefits, but it was far more than was legally required, far more than would be morally required. So we cut the cost of doing business of WSIB by 50%. Allan, that's $2.5 billion reduction just in WSIB payments. Then we put in an accelerated capital cost allowance that allows businesses to write off their costs in year. And that was $1 billion savings. Then we lowered the cost of industrial and commercial hydro by 15%. That's $1.3 billion. And the list goes on and on and on. And I would say to you, we need to keep adding to that list of where we can save businesses additional dollars. I think that's what we need to just keep doing. Keep doing what we're doing, to be honest. It's working.
Yeah, no, it sounds like it. Obviously, cutting costs for businesses is obviously very enticing, right? And
Yeah.
So setting up shop here and doing it at a cheaper than elsewhere, obviously is a competitive advantage.
Yeah.
Leads me to my next question. As Minister of Economic Development, are there certain industries or sectors of the economy that you're focusing on with respect to bringing companies to Ontario to grow the economy? We've seen, as you mentioned already, a lot of announcements in the EV space. But are there certain sectors of the market that you're more focused on to try and maybe diversify a little more the economy of the province?
Excellent question. So we set up our investment agency. It's called Invest Ontario, and that is to help fund and to help do the due diligence for us on the various sectors. And they are not quite restricted, but focused purely on advanced manufacturing, tech, and life sciences. Those are the three areas that we excel in Ontario. And so we're going to fish where the fish are. And so we're working very diligently. We saw big investments in, again, EV, we saw that. Just think about the EV and what being proactive does. In 2019, Reuters announced that there would be $300 billion worldwide spent on the development of EVs, zero coming to Canada. So that's where the Premier said, we've got to kick it in gear. And that's when we reduced the cost of doing business, as I said, with the WSIB. That number, by the way, is $8 billion annual savings to business. That's a real number. And so just last year, Bloomberg announced that Ontario is the number 2 in the global supply chain of EVs. Imagine going from zero investment to number 2 in the world, only after China in EVs, number 1 in North America. So that's a strength, but that's going to come to an end. All the EV companies this year will have a place around the world. They're going to be settled in. If they're not settled by this year, they shouldn't be in the business. So that's going to move, and we're going to start doubling down on life sciences. We put a life sciences council in place. We have a life sciences fund. We've developed a life sciences strategy.
Yeah, I know EVs is obviously something that top of mind really for everybody. You know, we were talking on another show about EVs, and then the cost, right? The cost of making electric vehicles to the the cost for these automotive companies to be profitable. It's difficult. You know, a lot of these automotive companies have turned to hybrids, and they've kind of slowed down the manufacturing of EVs. Have you seen that slowdown? Has that affected the business?
Not here in Ontario. We only at the moment make the Bright Drop electric vehicle, which is General Motors' delivery vehicle. It's a delivery van for FedEx. And so right now, that's the only one coming off the assembly line. Brampton, they've now are in the process of converting the entire Brampton facility from internal combustion engine, from ICE to EV. 2026, Ford will then convert their entire facility to EV. So in the meantime, we're pumping them out. I mean, Ontario is the number 2 automaker in North America. So it's a position we cherish. But think about this as well. We're also, with 414,000 employees plus, we're also the number 2 tech cluster in North America. This is a spectacular piece. We are going to overtake Silicon Valley as the number 1 tech cluster.
Wow, that would be unbelievable. Obviously, Silicon Valley known for tech. That's what they're known for. So when I talk to the premier, the finance minister, and now yourself, always the topic. When I tell people I'm doing this interview, 2 things always seem to come up, and that is higher taxes and higher interest rates. Inflation is getting a little bit better, but for now, the higher taxes, higher interest rates. Is this, or has higher taxes? We're I think the 4th highest for taxes jurisdiction in North America. So have the higher taxes, the higher interest rates, has it made it more difficult to improve the economy in Ontario?
When you look at the taxes, part of what we did when we got elected was begin to reduce that. Again, we put an accelerated capital write-off, so you can write off your equipment in year. That's $1 billion tax savings. We did not go ahead with the previous Liberal government's tax increase that was planned for January 19th. $465 million was to kick in. Not only did we not do that, we have not changed or increased any taxes since we've been elected, only rolled them back. So we put in a 10% manufacturing tax credit in the last budget. Everything we've done is to roll back taxes, reduce taxes, no increases whatsoever. Your hunting and fishing license didn't even go up. I mean, we are pushing hard at reducing the cost. And then we've put in sort of family-friendly and business-friendly and farm-friendly things like the 10 cent a liter gas tax reduction. So we're all about reducing. We're going the other way on the taxes. And so that has helped us when the business community around the world looks at Ontario and sees, okay, that's the stability, that's the credibility we want in a government, is that they understand lower taxes equals better business. So I got to put a cherry on top on this one. So here we are. We've pulled on every government lever possible to lower the cost of doing business. So we've reduced our own revenue by $8 billion a year. And what did that do? Put 700,000 people to work. We saw billions, tens of billions of investment come in. But here's the really interesting one. The day we got elected, our revenue in Ontario was 154 billion. So we reduce our revenue and let business grow. Today, 5 years later, our revenue is 204 billion. So our revenue increased by 33% in 5 years. Lower taxes equals higher revenue. That's the formula.
And that's amazing. And you hear often that government wants to raise taxes because they need to cover what they're spending.
Yeah.
And as the premier said when he was on the show, governments don't have an income problem, they have a spend problem. And so you
Yeah.
reduce the tax, you grow the business. It's definitely a recipe for success for sure.
Yeah. Yeah.
You bring up the jobs a few times, and I thought we would end our interview with a couple of questions on that, the jobs growth. And so when you look back to April 2023, the unemployment rate was around 4.9%, just under 5%. Today, the last number we have, which was December of last year, it's up over 6%. Where do you think the jobs number is going to kind of level off? Do you foresee it getting back up to over 7%, which has been the average, I guess, for many years? Obviously, we're creating a lot of jobs. We're bringing a lot of new businesses to Ontario, as you mentioned. Where do you see jobs growth going in the near term and I guess in the future?
Well, we continue to bring companies here. We continue to land companies. Volkswagen will have 3,000 new employees at the plant. The Nexstar plant in Windsor will have 2,500 new employees. So we're going to continue to bring the jobs in. The business community has reacted to our lower cost regimen by hiring almost 700,000 people, but we still have about 380,000 unfilled jobs in Ontario. So that's the real push. That's why we're spending so many billions on skills development and skills training. We know that we need more immigration. We brought in 500,000 immigrants into Ontario last year to help fill these jobs as well. These are permanent residents coming to this land of opportunity in Ontario. We expect more than 500,000 this year. So once we start to level out, we'll have a better idea. But the employment number, no matter where it is always a technical number. We just know we have 380,000 unfilled jobs in Ontario, and we're training like heck to fill those jobs.
To fill them, yeah. So immigration, I guess, is playing a role to fill a lot of these jobs.
Yeah.
I guess my last question, and it pertains, I guess, a bit to the U.S. And you probably saw the numbers out of the U.S. today, jobs data. They grew over 350,000 jobs, well above what they were anticipating. Their GDP numbers look to be pretty good. We're looking, some are calling for a 3-4% GDP number for the first quarter. How does that play out for us here in Ontario? Obviously, we know that most of the things that we pull out of the ground and build end up going down to the US, number one trading partner. So to see their growth in jobs, 353,000 this morning, to see their GDP, to see their consumers still continue to spend and buy product, that can only be good for us here in Ontario, can it?
Yeah, the expression when the US sneezes, we catch a cold, but when they grow, we also grow with them. They are, as you said, our number one trading partner. It's interesting. I just got home from a trade mission to Mexico last night. And this was a big topic because Mexico and Ontario were each other's third largest trading partner. Everything that happens in the States affects us both. So when we see the kind of job numbers they had today, that's very encouraging. Mexico has switched with China, that Mexico is now the US's single largest trading partner at 800 billion a year, followed by China. Number 3 trading partner to the US, province of Ontario, $460 billion in two-way trade. We are the US's third largest trading partner. People would not know that at all. There's 9 million Americans that wake up every morning just to make products to ship to us. That's how reliant we are on each other. So when you've got good growth in the States, this is also very good news for us here in Ontario, and vice versa.
Yeah, for sure. I think the US, a lot of people were waiting for the recession that I guess never happened. And they seem to be in many areas re-accelerating, which is why I guess Bank of Canada, or in this case, the Federal Reserve, are
Yeah.
a little bit concerned to see reacceleration, obviously from an inflation standpoint. But I guess from all of us, we want to see the economic development. We want to see the growth. So it's great to hear that Ontario is doing as well as it has. I want to thank you for taking your time out of your busy day to join us, Minister Fedeli. Thank you so much for giving us some, I guess, fantastic information, staggering information that many of us wouldn't even know how well our province is doing at this time. It's just unbelievable to hear how large these numbers are getting. And as you mentioned, they're only getting better going forward. So thank you, sir. It's been a pleasure to speak with you.
It's been all my pleasure, Allan, and a really great opportunity to share some of those remarkable numbers. Thank you.
Thank you so much. Take care. That was a great interview with the minister, giving us some unbelievable stats. The third largest trading partner to the U.S. is Ontario, and talking about the Toyota plant. The best automobile plant in the world today is actually in Ontario. So some just tremendous stats. Hopefully all of you got something out of that interview. I sure did. And hopefully we'll bring back the minister again down the road to see how things have progressed. And we'll ask him to come back. I'm sure he'd love to do so. So we'll stay tuned for that. Now the part of the show where I talk about the 3 things that I think individual investors should consider before you make your investment decisions. And you actually have those 3 things here in front of you. Economic data. And what I mean by economic data, I mean CPI or inflation numbers. I think those numbers are going to be really important to focus on out of the US, and they're going to be reported, I believe, early next week. Looking for growth. If you are looking for growth in your portfolio, which tech names should you be focusing on? Perhaps which tech names should you maybe take a pass on right now? Perhaps looking for better value down the road. And the third and last one, or last topic that I have for you, should you be contributing to your RSPs or a tax-free savings account? A question I get every year at this time. We are in the midst, or right in the heart of RSP season. Deadline for RSPs, February 29th. For those that want to deduct the contribution for 2023 income tax purposes, you have to make that contribution before February 29th. So getting a lot of questions regarding RSPs and TFSAs. So let's go to the first one, economic data or CPI. And we have a good chart here. We've shown this chart many times on U.S. Consumer Price Index, or U.S. Inflation. And you can see here that if you look at all items pertaining to inflation, the headline number, you would see that it is 3.4%. The core inflation number, which is what the Federal Reserve looks at more when you strip out volatile food and energy, it's now, for the first time in a long time, come below 4%. It's actually 3.9%. So headline inflation, 3.4, core inflation, 3.9. Now, the headline number actually is ticked higher. We were actually lower, or the U.S. was actually lower recently. They were just above 3.1, and now moved to 3.4%. So I think this next number, or this next inflation reading, will be very important because we continue to see growth in the United States. GDP looks to be in the 3%, 4% range. We're seeing retail sales come in strong. Recent manufacturing data that was released out of the US also showing gains. Consumer sentiment, consumers are feeling confident in the economy and where it's going. That is strong. And this whole notion about the next move for the Federal Reserve being an interest rate cut versus an interest rate increase. All that in mind, it's really playing out in the economy. So can we see a resurgence in the economy and still get lower and lower inflation numbers, hopefully getting towards the Fed's target rate, and the Bank of Canada's target rate for that matter, of 2%. Many people believe that the 2% will be very hard to get to. But if you look at a 6-month number out of the US, you're looking at an inflation rate that is actually close to the 2% target. So over the next couple of quarters, if we can see inflation continue to fall, as is the expectation from the Fed, there's a possibility that we could see the Federal Reserve cut rates down the road. So a CPI number early next week will go a long way to tell us what's going on in the economy, and obviously the stock market will pay close attention to that. The second topic, which is important, I think, for individual investors to consider, is this idea of if you're looking for growth. We all know technology has been an important part of growth over the past, well, all of last year, pretty much, and even the first 5 weeks or so this year. Which tech names should you be focusing on? And I have a couple of charts of some names that I think you could still buy. They have gone up recently, but names that I've been looking at for those investors that obviously can handle the volatility of owning a technology stock, a big cap technology stock. Perhaps you want to look at these two names, and two of the names I've chosen. First, Oracle. Oracle is a name, big cap tech name that many people know. They do many things, but one of the things they talk about recently is artificial intelligence and how they've incorporated AI into their business. You know, they obviously software, services, hardware, they do a bit of everything. And Oracle is a name that was doing extremely well, came out with earnings, I believe it was last quarter, that they reported disappointed the street or investors. They came, their expectations, they actually beat expectations, but their guidance for future growth was a little bit soft. And we saw the stock trade down, as you can see on this chart. We had a kind of a double top in, looks like in, let's call it end of June, and then again another top just getting close to September. And then everything kind of fell down towards November. And we've seen some ups and downs since then. But I think Oracle is a name that you could take a look at if you're looking at technology today. Second chart that I have of a name that I still believe goes significantly higher, and we've talked about this stock many times on the show, is Alphabet or Google. And we can pull up a chart of that Alphabet stock. There it is. And you can see that it has gradually been moving to the upside. But again, the best word to describe it is gradually. Whereas you take a look at some of the other tech names, which I'll show you in a moment, and they've been moving significantly higher because of artificial intelligence primarily. And a name like Google obviously will benefit and already has benefited from AI, but they are obviously big in search, big advertising. You know, their YouTube numbers were slightly below what was anticipated. So again, when they released earnings, I guess now a few weeks ago, they reported, and their stock actually fell because of the release of some of their ads, or some of their ad revenue, I should say, and some of the numbers regarding YouTube. So a name like Google or Alphabet, I believe, is a name that you can own from a tech perspective. And a couple of names that you may want to avoid, right? As I said, this topic is about choosing the right tech names going forward for growth. Well, some names that you may take a pass on right now if you already don't own them. First one, NVIDIA. We've talked about NVIDIA all the time on the show. Look how much this stock has gone up in such a short period of time. We're talking just in the past year or so. You can see how it's gone from the bottom left, well above anything we were expecting. Top right, can you be buying NVIDIA today? Well, I think over the long term, NVIDIA continues to move higher. Perhaps a stock split in the mid is in their future. But right now, maybe you want to take a bit of a pass. You know, they're starting to trade at higher multiples. Maybe you want to wait for a bit of a pullback. And the second name in a similar space or area of the market is AMD, another chip maker and a company that is, I guess, a rival to NVIDIA in so many areas. AMD, we can pull up a chart of that, and you can see AMD going significantly higher again here as well. So a name that I've been purchasing for individual investors, for investors that can handle the risk of owning a tech name like AMD and NVIDIA for that matter. But perhaps you want to maybe take a bit of a pause here. These names have really gone a lot higher over the last, let's call it year and a half. And in case of NVIDIA, maybe the last couple of years. So maybe those are names you have as a hold, and you take a look at some of these other big cap tech names if you're looking for growth when you make your investment decisions over the next few weeks. The last topic I wanted to address for this show regarding when you make your investment decisions, where should you make those purchases? Should you make them in an RSP, or should you make them in a tax-free savings account? And we have an excellent chart to put up, and that compares RSPs to TFSAs. One thing I do want to point out that the annual contribution limit for TFSAs is actually $7,000 now. That was increased this year. It was prior to this year, 2023, was $6,500. Prior to that, $6,000, and then $5,500. So this chart, I guess, has to be updated there. But other than that, this chart is pretty good. It gives you really the differences between what you can contribute to a TFSA versus what you're allowed to contribute to an RSP. RSP, 18% of previous year's earned income up to a certain maximum value. One of them does not provide a tax deduction, which is your TFSA, whereas an RSP, if you need a tax deduction for income tax purposes, the RSP is where you want to invest. At the same time, when you pull money out of an RSP later on in life, you have to pay income tax on what you pull out. TFSA, you can pull out whatever you want and you don't get taxed. So just highlighting a few differences between the two products or account types. One is tax-free, one is tax-deferred, which is your RSP. A lot of people think, when you pull money out of an RSP, it's tax-free. It's not. You will pay income tax at that time, but obviously the idea is when you're retired, making less money, you will pay less in income tax when you pull the money out. So understanding whether an RSP or TFSA is right for your contribution now or this year or going forward, I think is a very important thing for individual investors to consider before you make your investment decisions. Business and consumer bankruptcies. This is something that, unfortunately, we've seen a pretty big jump in over the past year. And the numbers are actually quite startling. We're seeing business insolvencies go up by quite a bit. We're seeing business insolvencies go up by 41%. And I looked down because I just didn't want to make a mistake on that number since 2022. So from 2022 to 2023, 41% increase in business insolvencies. And it's startling. That is the largest increase in 3 decades. We haven't seen a number like this in a long time. And it's interesting. Some of the reasons for that businesses have mentioned in these surveys are, higher input costs. They're seeing a rise in costs of running their business. Wage costs are going up. We've seen wage inflation. Recently, we've seen wages kind of level off in Canada and the United States. But prior to that, wages were going up at a pretty good rate. And last but not least, and probably the biggest change that we've seen in the last few years is basically debt servicing costs. The cost to service debt for a business has gone up quite a bit. And that is your higher interest rates, right? You borrow money to build out a business. You borrow money to invest, perhaps buy a new business or add on. You want to buy equipment or whatever you're borrowing for. These costs are obviously rising as interest rates have gone up significantly. And so we've seen a lot of business insolvencies. Now, consumer insolvencies, those too have gone up by 23% from 2022 to 2023. That is a 14-year high. So even the consumer is finding it more difficult. Things are rising, costs are rising, and things are for most consumers been a little bit more difficult. Inflation, really overall, we've seen consumers continuously talk about mortgage rates and mortgage interest. So those that have a mortgage, those individuals are finding things a lot more difficult than those that are fortunate enough not to have a mortgage on their house. And we know a mortgage for an individual is probably the highest or the largest debt that someone will take on. One of the startling stats I looked up just this morning, and I was talking about this to some of the individuals that help work with me on this show, prepare the show for you every 2 weeks. We were talking about how much in debt the average Canadian is. And once upon a time, we saw that the average Canadian, for every dollar they made, they were in debt about $1.50. And then it jumped to $1.60. Well, as of today, the latest stat I saw, for every dollar that the average Canadian makes, they are borrowing $1.85. So this is a number we have not seen. I can remember seeing a number that has continuously gone higher. And, with interest rates moving higher, this is a very difficult thing. And we all wonder how long it's going to take before the consumer really stops the spending. And that is something that, I've talked to, professionals about, experts in the field of insolvencies, what they've said, and they've told me that they're already seeing cracks in the spend. And we have a few charts here that I wanted to highlight. The first one, insolvencies in Canada. You can see here on the far right-hand side, 2023, how much insolvencies have gone up in 2023. So you've seen a jump there. The household debt by country, we talked about the $1.85 per dollar of income. Next chart we have here shows how indebted the average household is in our country. And you can see Canada is not the worst, but we're definitely well down towards the highest indebted country out of the OECD countries in the world today. And I think something that the average person needs to work on, because we're seeing more and more insolvencies. And if interest rates are to continue to stay elevated, they may come down a little bit over the next year, maybe 2-3 rate cuts, but we're still not going to see, in my opinion, where interest rates were, maybe 5 years ago. So something to be mindful of, something to consider, and I guess, again, some perhaps alarming stats on business and consumer insolvencies. So both the central banks, the Federal Reserve and Bank of Canada, have made comments recently talking about how they don't really see interest rate cuts in the near future. I think it was wishful thinking, to be honest, that investors thought the first cut could come as early as March, with the economies of both countries really showing tremendous resilience with respect to growth. Obviously, the US growing much quicker than we are here in our country. But as Minister Fedeli said, when the US sneezes, we catch a cold. If the US is going to continue to have GDP numbers in the 3-4% range, and I believe the Atlanta Fed right now is predicting around a 3 to 4% increase in first quarter GDP of this year, then Canada and Ontario in particular will reap the rewards, because as we know, they are our largest trading partner, and it could only benefit us here in our country if the US continues to do well. And so with the US doing well, Canada kind of flatlining, but still growing, even though it's only a little bit, but they're still growing. We have not gone into that mild recession that many people were anticipating here in our country and in the US. And frankly, with strong numbers in retail sales, GDP, I don't think you're going to see the Bank of Canada nor the Federal Reserve cut rates, at least until the second half of this year. And I've said this multiple times. I think the first rate cut happens perhaps mid-year. And so, again, a few charts to show everybody. First chart, Bank of Canada policy interest rates. You can see here that they've kept at 5% for quite some time. And you can see on the far right-hand side of the chart, we can show the chart, that there have been no interest rate increases. There you go. Over the last, I guess, call it 4 meetings. And that is obviously very important for mortgage goers and people that invest in the markets. The next chart we have here, the U.S. Federal Reserve policy rate. Again, you can see how it is flattened out at 5%, 5.25 in that range. Once again, you look at the inflation rate as being, 3.4, 3.9 on the core. It's a big gap between the 5% Fed funds rate and inflation rate in the United States. And I guess the last chart or actually we have 2 more charts here. We have a chart on Bank of Canada and the Federal Reserve, both holding rates. You can see this is a GDP chart. You can see how GDP has fared, gross domestic product. how it's done in the US, and you can see how well it's done on the far right-hand side. And last but not least, we have a chart on job creation, jobs growth in the US. This is a December number, 216,000 was created, but I can also tell you for the month of January, the US grew 353,000 jobs. And so with strong data like that, with consumer sentiment from consumers being much better, we're seeing data showing much more positive, a positive consumer. Oil prices cooperating. We're seeing oil still in the low 70s. And so we're seeing a lot of different things giving us positive signals on the economy. And with that, I think that Federal Reserve and Bank of Canada, they're just not in a hurry to be cutting interest rates. So if I were an investor today, which I am, and obviously invest for many people, I think you can count on interest rates staying at these elevated levels, at least for the foreseeable future. Now we come to the top 5 reasons that I wanted to list today that perhaps could cause 2024 to have a bit of a snag. And it's interesting because, we talk a lot about how this is going to be a positive year. We speak about, the markets doing well this year. And really, I think for most investors, coming into 2024, they came in on a high note. As I said, inflation is coming down. The Fed and Bank of Canada, for that matter, seem to be ready to act if the economy should falter. They've said, yes, they're not in a hurry to cut rates, but at the same time, if we should see the economy really take a dip, I think they'd be there to react very quickly. So I guess the Bank of Canada has our backs, in other words, and a win-win situation. However, what could kind of derail that thinking? And I listed 5 things here. Resurgence in inflation, the Fed taking too long to cut rates, geopolitical events, we'll touch on that, valuations getting stretched based on future potential earnings, which could maybe produce a bubble like we saw in 1999. And last, Fed speak. Federal Reserve governors are always speaking, and whenever they speak, they tend to move markets. So wanted to get into each one of these just briefly. First one, what could derail the markets in 2024? Well, if we saw a resurgence in inflation. And what would a resurgence in inflation cause? Well, they would cause interest rates to move higher. And we have a couple of charts, one on the US 10-year, and this is a 1-month chart. And you can see how interest rates, or the 10-year, has spiked higher recently, because as soon as the Fed says things are going well, we don't really need to cut rates so soon, Treasuries start to move higher. And we saw the 10-year moving higher. Now we have a chart on the 2-year, and you're going to notice a similar thing. The 2-year moving significantly higher based on really this, I guess, idea that the Fed is not going to be cutting rates anytime soon. But if we get a resurgence in inflation, the risk is that all this talk about cutting rates could turn to raising rates once again. And I know at the Fed's last press conference, they've stated that rate increases are not off the table. That if things were to start to gain steam again, like the Fed saw way back in the 1980s, where they started to cut rates only to raise rates again as inflation surged higher once again, that is something that they don't want to see, and they're very mindful of. And again, we have the another same chart we saw earlier on U.S. Consumer Price Index. We can show that once again, and you can see once again that the rate is 3.9 and 3.4%. Second reason why economy could hit a bit of a snag this year is perhaps the Fed taking too long to cut rates. So the kind of the opposite side of things. And we have 2 charts kind of side by side on that, showing the Fed funds rate at 5.25. And on the left side, you can see the inflation rate much lower. So the Fed does have wiggle room to cut rates. If they wait too long and they keep interest rates at these high levels for too long, that could derail things, because that could really slow down this economy in the United States. And obviously, if the economy in the US slows down, well, you can guess that the economy in Canada will slow down with it. So the Fed is kind of walking on eggshells, walking a bit of a tightrope. They don't want to cut too soon, but they don't want to cut too late as well. Another or a third point that could derail the markets in 2024, geopolitical events. Obviously, we've seen and heard of what's going on in the Middle East, Ukraine, and recently what's going on. And we've shown this actual, it's not really a chart, it's more of a picture of what's going on with the supply chain. Countries shipping oil, shipping goods through the Red Sea, Straits of Hormuz, Suez Canal, the Houthi rebels attacking a lot of these vessels that are bound for the United States, the UK, Israel. And they're basically saying as long as the war goes on, then they will continue to attack these vessels. So if a war were to broaden out in this region and things were to get worse, if things, let's say supply chains were really to become even more restrained, I think that could eventually affect the economy and therefore affect the stock market as well. So geopolitics, I believe, could have an effect on markets if things were to get progressively worse. The fourth one that I had up on our list, valuations getting stretched. Everybody's always afraid of valuations getting stretched. We have a couple of stocks here that talk about or that show a couple of names that we've seen. They were once upon a time cheap, trading at 12, 13, 14 times earnings. Now all of a sudden trading at 16 times, 17 times earnings. Names like Caterpillar. We have a chart on Caterpillar, and you can see that we go from the bottom left to the top right. We have a chart on United Rentals, which is in a similar business. Caterpillar is more global. United Rentals is more North American. United Rentals rents equipment. Caterpillar mostly sells the equipment out, both in a similar business, similar sector of the economy. And you can see United Rentals has moved significantly higher. And one more name that one would argue that maybe their valuations aren't too stretched, trading in that 25 multiple range, is Meta, or formerly Facebook. But you can see how much that chart on the far right-hand side has moved higher. Stock moved up 20% after they came out with earnings. Unbelievable. The biggest one-day gain in a stock in history. Market cap of the stock went well above $1 trillion. And so many people now think, well, maybe it's a little late to get into Meta, and perhaps we should take a pass. So valuations get stretched, and individual investors find things hard to buy. I think that could bring down the stock market and prevent it from moving higher. Lastly, as I mentioned, Fed speak. And we have a few quotes from the Federal Reserve here to show you. One from, actually two from Jerome Powell. We can put those up. Jerome Powell said recently, we're not looking for better data, but we're looking for continuation of good data that we're getting. We just need to see more. So they want to see more good data, meaning inflation coming down before they lower interest rates. He also said in a 60 Minutes interview, which aired last Sunday, we have strong economy. Growth is going on a solid pace. The labor market is strong, 3.7% unemployment, still near all-time lows. With the economy strong like that, we feel we can approach the question of when to begin reducing interest rates carefully. And we want to see more evidence that inflation is moving sustainably down to 2%. So again, they're talking about being cautious, at least Jerome Powell was. And our third quote from Loretta Mester, the head of the Cleveland Fed, and she also, again, reiterates this, we're not in a hurry to move interest rates lower. We want to continuously, or we want to see more and more data showing that inflation is approaching our 2% target. So Fed speak, I think if it becomes a little more aggressive, a little more hawkish, that could also, unfortunately, put a bit of a snag into what we are predicting for 2024. So overall, I don't think that these 5 things are going to happen, that they are the base case. I believe the stock market will have a positive year once again, but I think you need to keep these 5 things in mind, because if they do flare up or pop up, 1 out of the 5 or 2 out of the 5 or more, then I think that 2024 can be challenged at certain points. But overall, I still maintain that 2024 will be a positive year. now the part of the show which when I take questions from the audience, questions from the viewers. I know the show has been a little longer than normal. I know the minister had a lot to say, and I thought it was really good information for everybody on the statistics that he gave and the information he provided all of us. So we have time maybe to squeeze in just one question here. Let's take a broad-based or general question that I actually received over the last 2 weeks. And that is, how often should I be meeting with my financial advisor? What is the normal rule of thumb? Is twice a year a good frequency? And so my answer to that question as an investment advisor myself is, in my opinion, you should meet with your investment advisor as often as you feel necessary. Should you meet with them every day? Obviously not, but meeting with them once a year, twice a year, perhaps 3 times a year to, for that face-to-face meeting, I think is important. You should be in contact with your investment advisor on a regular basis. What does regular mean? Well, it's different from all people. Some people, regular means every month. Sometimes, for some people, it means once a quarter. Or for some people, may mean once every 6 months. I think it's important for an investment advisor to be in contact with you. I try to be in contact with all my investors, with all my clients, people I manage money with or for that I manage their portfolios. I try to be in contact with them every couple of months, either through general commentaries or specifics for their individual portfolios. So to me, there really is no rule of thumb. I think it just depends on the investor. So with that, I want to say thank you for tuning in today, for all of you taking the time out of your busy day. I look forward to seeing you all again in a couple of weeks on February 21st, same time, 12 noon. And until then, happy investing.